Testing, testing, testing. Can you hear me?
You sound awesome.
Sweet. All right. What's up, everyone? Welcome to the Business Breakdown Podcast, episode 24. Today, we're diving into the world of real estate syndication with Jennifer Falloon, founder and CEO of Vorsa Investments. In this episode, we're unpacking the essentials of real estate syndication, how to spot winning deals, navigating SEC regulation, and the future of real estate investing. Whether you're a seasoned pro or just starting out, this episode is packed with game-changing insights. Quick community shout out, join our Facebook group at facebook.com/group/finance for individuals and businesses for more exclusive resources and networking. Let's welcome our syndication specialist. How you doing, Jennifer?
I'm awesome. How are you today?
I am doing pretty good. So what state are you in?
I'm in Missouri,
Awesome.
but tomorrow I'm headed to Arizona. So it could change at any minute. So super fair
Nice.
question to always ask, where in the world am I?
Yeah, because I know you do business all over the U.S. What states are you currently doing business in?
Missouri, Texas, Florida, Louisiana, Oklahoma, Tennessee.
That's awesome. And what kind of business are you dealing with in some of those states currently?
RV parks, and apartments.
That's awesome. So do you want to introduce yourself to everyone and we can dive into it?
Yeah. So, I mean, like Scott said, I'm Jennifer Falloon with Vorsa Investments, and we're a syndication and acquisition company. So we buy commercial assets all over the United States. And what we do is we syndicate, which means we raise money from busy professionals that want to own the real estate, but they don't want to be the landlords. So we take care of the tenants and toilets so they don't have to. And we share in our profits, give them a K1 so they're not in a tax bracket, which is awesome for high net worth individuals. And then we also share in the back end profits, which is where the wealth is really made.
Oh yeah. That's for sure. How'd you get into this? It's so I'm sure there's a very kind of long story to it, but like initially, how did you kind of get introduced to it?
Yeah. So the super short version is this was my husband's love. This was not what I wanted to do. To me, when somebody said real estate, I automatically thought of being like an agent, right? And I'm like, I don't want to go to school. I don't want to be an agent. I don't want to show houses on Saturdays and Sundays. And so when I learned through him about the investment part, I was like, this is totally something I can do. So it was really his initial love. My son
Right.
came on board and I came on, this is really truly a family built business. And we kind of fell in love with it all together and we run it all together.
That's awesome. That's cool whenever you can get family together and be able to create a good functional business.
And it's a legacy, right? So
Yeah.
like their kids, my grandchildren will run this business one day.
That's cool. That's going to be cool to look back on and kind of see what you created. So walk us through a typical syndication deal. Kind of how people get how does someone even get involved?
Yeah, so let's back up just a smidge if you don't mind, because
Yeah.
there's a lot of people that they don't even know what a syndication is, right? So like we get it, they just don't know. So what it really is the pooling together of monies, right? So if you have 50 grand laying around from an old dormant retirement account, your aunt has money that she saved up through the years. It's making 0.1% in, a savings account. We pool that money together. High net worth individuals, again, that are looking for tax breaks. They're looking for diversification. We take all of that money, put it in an account, and with that money, we purchase the down payment and CapEx of, say, an apartment complex, an RV park. We could buy a laundromat, storage units, car wash. So that's the syndication part. So it's not a REIT like you would get in the stock market. You have actual ownership in the property. So anybody that gives their money to, say, an apartment complex, RV park, it's yours. You can go, you can touch it, you can visit it. You can say, I own this RV park. I own, these apartment complexes.
Yeah.
And yeah. And so how do you get into one? Well, first of all, you have to know, who the syndicators are. And you really need to know who are the good guys. And not that I want to say bad guys, but there are operators out there that, aren't as integrous as they should be. So it's very important to vet your syndication. And I actually have an ebook about how to do that. The questions that you should really be asking before you jump into a syndication.
That's pretty interesting. Do you just download it from your website, or how can people get access to that book?
So yes, it is on my website.
Awesome.
And then you can also go to Vorsa Investments. The cheat code is vorsainvestments.com/vet, VET.
Yeah, that's awesome. And then we can even include a link in the post that we're going to have later for this episode, so people can have access to that. Man, so people can get into it. What if they're specifically trying to, I guess, create their own project? Would they bring that kind of deal to a syndication as well, or do they just kind of figure out what the syndication invests with and then kind of move forward with them?
Yeah, so really there's multiple ways, right? So there is, yes, if you have a deal and you're like, I have a deal, but there's no way I can raise money. I don't know anybody with money. I don't know anybody that knows anybody with money. Yes, you can present that deal to, a syndication company, acquisition company, which Vorsa Investments is both. We do the acquisition and the syndication. So, if somebody came to us and said, I have this great deal, can you raise money for me? Yes, we can totally do that.
Can you explain why there is a difference between the two? Why it's broken out into two pieces?
Absolutely, because it is two pieces, right? So I might be able to find a deal, but I can't raise money. So I need to find the people that raise the money, right? So the acquisition is the actual taking down of the asset. So you underwrote it, you determined that it was a good deal on paper. Maybe you even did the preliminary due diligence. You visited the property. You know that it looks like it does in the pictures. The numbers match the physical asset. Like if it says, it needs roofs, you go, you visit it, it doesn't really need roofs, or they say it doesn't, you get there and you realize it does, right? So there's that part, which is completely separate from taking this underwriting, determining that it's a good deal, and presenting it to possible investors to bring their money into this deal to fund it.
Yeah, that's pretty interesting. So how does a syndication deal kind of begin? So you found a decent deal, and you start kind of the due diligence that's behind it. What's the initial due diligence that you're really looking for?
Yeah, so we're wanting to make sure that the deal is as safe as possible. So we're really not allowed per SEC to say the word safe, but at the end of the day, that's what we're looking for, right? We're looking for a property that mitigates most risks, right? So there's risks in everything, and there are things that none of us have a crystal ball. So there are things that are always going to be unknown. But what is the worst case scenario? And does that worst case scenario keep us from actually losing any money, right? So, for example, if we did everything wrong and we just blew it, could we at least sell the property for what we've paid for it and break our investors out even without losing any money? Can we at least just break even? And that's the kind of deals we're looking for, right? Is the very worst case possible scenario still keep us from losing money? That's the deals we want. So that's what we're underwriting. And we have, like at Vorsa, we have a very conservative underwriting, right? So we want to make sure that all worst case scenarios are played out in our numbers. Before we didn't know what COVID was, before 2020, but we used to say, what if aliens came and abducted half of our tenants? Could we still make the mortgage? And that was really funny. Everybody chuckled until COVID happened. And then that scenario wasn't funny anymore. But we pulled through. We did great. We made more money during COVID than we had ever prior. And so I was kind of like, bring on another COVID, and I got the planes and the airports all to myself. It was amazing. But that's what we're looking for, right? We're wanting to make sure that all risks are covered.
Yeah. Yeah, that's usually a really big piece whenever you're trying to find a decent investment. Even, I mean, people are always looking for some kind of diversification, because that's what they hear all the time: diversify, diversify, diversify. And getting into real estate, where there's a lot of deals where you can find something that is worst case scenario, you sell it for what you bought it for, kind of thing. So it's almost at zero risk kind of thing. And that's always a good win-win, and it's a good feeling from the start. You're not super nervous about that investment moving forward, but obviously these kind of investments are for experienced investors. It's some people like to have a knee-jerk reaction whenever they're first getting into something like this. They have high emotions and all that stuff. I'm sure you might be familiar with that.
Mm-hmm. Yeah, we still do, right? We've done several deals, and that adrenaline still kicks in.
Right.
Yeah, but it's fun, and it's exciting. And then when you're getting ready to cash out and you're looking to, get a check for a couple $1,000,000, like, that's life changing for anybody.
Yeah, absolutely. So whenever you get a kind of a deal, how does that syndication deal continue through your pipeline and your investor groups?
So,
Like
go
like
ahead.
after you get a deal, you're starting to do your due diligence, and then it starts going through. What's that structure look like
Yeah.
over
So
the next couple of years?
absolutely. So for me, I'm always raising money, right? I'm always looking for investors. I'm looking for people to collaborate with. I'm looking for referrals. And so what that looks like when we have a deal is, hopefully I've done my job well, and I have a pipeline full of investors eager to go. And then it's just pass or play. Like, we present the deal to everybody. And do you want to pass on it, or do you want to play? And so hopefully the deal itself is good enough that most everybody wants to play, and the money is raised. And so from there, we are SEC regulated. So we do have an SEC attorney that does the private placement memorandum, the PPM. And it's, 100 pages of everything about the deal, every detail about this deal. And then the investors sign off on it, and then it's go time. So typically, in a syndication, we accrue the interest monthly, but we pay it quarterly. And it's that payment, those quarterly payments, they're not super sexy, right? They're not making anybody rich. If you save them, you can go on vacation. You can probably make a car payment, house payment with it. But that's not really where the wealth is made. But it's, vacation money, it's play money, it's, or you save it. And then we hold every asset 3 to 5 years. So we don't have, we never want a mass exodus, right? So we do buy properties that are deferred in maintenance and management, typically owned by somebody elderly. They've had these properties, 20, 30, 40 years. They were great in their day, but as the owner got older, things just kind of started to fall apart. They're having a harder time keeping up. And so, we want to clean that up, but we want to do it in a fair manner. Like, we don't want a mass exodus. In all of my properties, I want single moms to live there and be able to afford to live there. I want the elderly to live there. I want our veterans to live there. I want to take care of that community and those people. So, we have to raise rents. That's just part of the nature of the beast. but I want to do it in a very ethical and easy manner, right? Like,
Right.
so that people want to live there and they can afford to live there. So we hold the property 3 to 5 years, and then we cash out one way or another. So if it's a property that we love the community, the state, the county, the city was very good to us, we'll refinance, cash the investors out, and keep it forever. If it's in a community where the city, state, county, they were horrible to work with, we all cash out and move on to the next.
Yeah.
Yeah. But we always, again, if we did a good job, our investors, because we know about when we're going to cash out. So we're already prepping for the next deal. And our investors, hopefully we've done a good job and they're like, I want to do this again. My dividend money was doubled. Plus I got my initial investment back. Like, let's go. We encourage them to file a 1031 exchange and roll that money over tax-free right into the next deal.
Right.
So I hope that answered your question.
Yeah, no, absolutely. Can you explain the 1031? A lot of people don't know what the 1031 is.
It's a tax code. So when I say K1, it's not any kind of special lingo. It's their tax codes in the tax code book. And that's really all I know. I don't know that they stand for anything special. I'm not an accountant, but I know my tax codes and I know when they work. And so the 1031 is, I guess, a tax code that allows you to take your initial investment and roll it over into a like-kinded investment. So real estate to real estate, for example, and I don't really know what else there would be, but you can take it, roll it over into the next deal, and it's tax-free.
Yeah. Yeah, no, it's a pretty big piece that I'm a little familiar with. It's just used by a lot of people, especially in your world. But from there, creating more deals, finding more pipelines, it's a lot of it has to do with networking. I was actually curious for like syndications. They're managed by the SEC. Is there like I guess a governing body, like some kind of association that they have, that all syndicates have to join, or is there like a annual conference for compliance kind of stuff that's nationwide, or what's that look like?
No, it doesn't. And if there is, I'm probably failing. But no, there isn't. It's just a filing that our SEC attorney files with the SEC. And there, are 100 rules of what you can and cannot do, depending on how you file. And we just follow those rules and pray we never get audited. But there's no conference, right? Like the rules of the SEC, hopefully you have a good SEC attorney, which we do. And he's very, open about what you can and cannot say. And there's syndication. There are attorneys that have YouTubes and Facebooks and all the stuff that, will help guide you. And that's really helpful when the laws do change. Right.
Right.
But we've used the same SEC attorney. So when the law changes or something happens, like we get an email and a phone call that says, hey, this changed. You can do this now or don't do this anymore. And so that's pretty much just how we're governed.
Right. Right. How has the landscape kind of changed in the recent years in regards to laws or any new regulation?
Yeah. So there are several ways to file as a syndicator, right? So there's a 506B as in boy and a 506C as in cat. And there's a 506D, which that might be the funds. I'm not really sure. But the 506B as in boy is for non-accredited investors and accredited investors. But you don't have to be accredited to join the syndication. And that's what we do because most of our investors are not accredited. They're just everyday working class people that have money or have come into money. And they're like, I know I need to grow this money. The 506C is in cat is only for accredited investors. So the benefit to a 506C is you can advertise. But you have to stay with accredited investors. Where the 506B, we cannot advertise our deals. Everybody has to be front loaded before we can even present a deal. But one of the best regulations ever that just changed is you can file as a 506c, do your advertising, get all your people in, and then switch to a 506b, which now is
Interesting.
like our people. So now we can be like, okay, we front loaded this deal, this syndication with all the, I call it big money. And now we can bring in, our regular people. And that's amazing, because especially when you're first doing a deal, not being able to advertise is, it could be detrimental to the deal. So that's my
Yeah.
favorite regulation. I have a CFO that really, in my company, that really follows that, and I just do what they tell me to do.
It's always good to have a smart team and a handful of
Mhm.
specialists in your tool belt,
Yes.
um, especially with compliance stuff. That's that's a lot of reading, a lot of stuff you got to keep up with. Um, so past the SEC, everything kind of goes good,
Mhm.
successful deal. Um, what are some challenges that you still might face um, going through? I mean, obviously, it's going to change from kind of deal to deal or
Mhm.
industry to industry. But what's something you might face towards the end?
Well, even before the end, like it could be the middle or even the beginning. Some challenges may be administration changes, right? So here we are in an election year, and it doesn't even have to be a nationwide election. What's scarier even than a nationwide election are the small town elections, right? Who's the mayor? Who's the city council? Like that's scarier to us than who's going to be president, right? But we could buy a property in an area where, they, I don't know, had like conservative, I guess,
Hmm.
local government, like they were kind of easygoing, they were easy to work with, they were pleasant. And all it takes is one administration change to have a new city council, a new mayor, and it changes everything. And it could be detrimental to our deal. Cities that are putting rent caps on apartments and landlords, that is devastating, right? And and people are like, oh, we want fair rent, right? A good landlord and a good acquisition and a good owner, they want fair rents too. But when you cap us, now you are creating slumlords, right? Because the money isn't there. I think there's this thought out in society that we just get this money and we get to go on vacation and we have fancy houses and we have great cars. And that is not the case. Like we have employees to pay. We have a mortgage. Well, number one is the mortgage, right? We have to pay our mortgage. We have to pay our taxes. We have to pay insurance. We have employees to pay. This isn't free money, right? And our rents depend on that. And when we do a good job and we're allowed to raise rents ethically, right? Like that's a product of our hard work. So when you're putting rent caps and those rent raises, again, we're not going on vacation. They go into an account that pays for things that we know we had foresight to know, what, the fridges when we bought these are kind of janky. They might be going out in the next 5 years.
Yep.
Let's
There's
put
no
this money in
warranty
a
or
fund
something.
to take care of that. The HVACs, like we don't want to take care of them right away, but they're kind of shady too. Let's put some money away, right? When there's no money to be put away and your refrigerator goes out, guess what? Your landlord's like, you're on your own. I don't have any money. When you have a roof leak, you better move because there's no money to fix it, right? And so what the rent caps are doing is they are going to create slumlords because there is no money to fix the things that are going to be deferred. And yeah, so that's a major problem in our industry. And, we might start out in a very conservative, landlord friendly city, state, county, and one administration change, can affect us. Taxes, right? Taxes right now, I mean, we're in a very high inflation time in our economy. The taxes are killing us, right? And when we underwrite conservatively, the banks will only allow us to pad our money so far, right? We can't overinflate like taxes. There's a cap in which we can inflate our taxes over the course of the 5 years. And if the taxes raise above what we were allowed to underwrite for, that's a deficit on our part. Same thing with insurance. We kind of expect insurance to double, maybe a little bit more than double, but the banks won't even allow us to underwrite a quadruple insurance hike, and yet that's what's happening. So guess what? Now we're in a deficit again, and hopefully our underwriting was conservative enough that even though we're in a deficit in this column, we can kind of rob from another column to make up for that deficit. But people that underwrite to the penny very liberally, any one of those deficits can be devastating to a property.
Yeah, could easily kill the deal.
Mm-hmm.
Could easily kill the deal, or at least the growth of the deal.
Right. And then, you have to do a capital call, which before I used to think, oh no, there's nothing worse than a capital call. And there are levels to a capital call, right? There's the capital call that was like, look, taxes went up more than we could underwrite for. Insurance went up more than we can underwrite for. There's these unknowns that happen, and we need to raise some more money. The deal is not going to be lost, right? We just need some more money in the bank for any more oh crap scenarios, which is far different than a capital call that says we are going under, we're losing everything, and everybody, all hands on deck. We need your very last dollar to make this work. So I used to be like, don't invest with anybody that has ever done a capital call. Well, as somebody that's done a capital call, there are levels to it, and it doesn't
Right.
have to be the end all be all.
Yeah, absolutely. So I know we just touched on a handful of things to kind of keep a lookout for. What are like some like green light things that you come across every now and then that are just absolutely killer, in a good way, whenever you're looking for a deal, whether it's multifamily or RV?
Okay, so I used to swear by multifamily, and now that we've done an RV park, I'm going to swear with the RV parks. Far less work, and far higher return. Like, it's just easy, right? Storage units, they are easy. The laundromats, the car washes, a mobile home park is also really good, probably a little bit more intensive. Like, I would put it under the multifamily, kind of like lots of work, but the payout is really good. I'm really digging these properties that are far less work, and the back end is still really good. The cash flow is still really good. And you can take where a multifamily or a mobile home park, at least for us, we're not so big that we can do multiple deals at a time. It's very time consuming, and it could really hold us up for half a year. Where the RV parks, the storage units, the car washes, man, we could do 2 or 3 of those and just bang those out. And very little maintenance, very little babysitting, very high cash flow.
Where have you been doing RV parks recently?
So just Missouri, which is kind of our own backyard, especially for our first one. So we only have the one, and we really wanted to be hands-on. And so we really wanted one in our own backyard. And now that, we're getting there and we're learning, and, we'll look at other places, and really places like that we want a vacation, right? So where do we want to hang out? Where do we want to drive our RV? So we'll probably look in, Tennessee, coastal areas.
Yeah. With an RV park, how different is that than a mobile home park?
Oh, it's vastly different, right? Because in an RV park, people are coming and going for the most part, right? And you want good amenities. So where the mobile home park is long-term, right? And you can run your mobile home park where you provide the trailers, and maybe you do just a straight rental or a rent to own type scenario. or you just own the park and they bring in their own trailers and they can take them and go as they please. I find that I want I don't know, I guess a higher class kind of mobile home park where like I want to determine what mobile homes are in there. I want to make sure that we have newer, clean, pretty mobile homes in a clean, safe, pretty park. And so I would want to be in charge of what mobile homes are in there, and then people can just rent them or they
Hmm.
can do a rent to own.
Right. With the RV parks, how does a deal like that work? What is the time frame similar to a multifamily, or what's the difference there?
It really depends. So it's super deal dependent. The mobile home or the RV park that we have is a 5-year hold. And it's a 5-year hold because the owner, we did seller financing. So, the owner, the current owner or previous owner, I guess, seller is the bank. And we were able to get 5% interest, which right now feels like free money. And so it's 5% interest for 5 years. And so there's our firm 5-year hold. So unless some miracle happens, like it did in, 2020, 2021, where interest rates are like nothing, we're probably going to hold it 5 years.
Right.
However, our investors know like, hey, if it drops, the interest rates drop below 5%, we're out. We're cashing out.
Yeah. Yeah. No,
Unlikely.
that's awesome. That's awesome. It's pretty interesting, kind of packaging that together. Have you been looking at a lot of other RV parks,
Yes.
or just mainly, or I'm sorry, have you been looking at other RV parks outside of Missouri, or just Missouri, staying in your own backyard?
Nope. So we are looking at other states for sure. And
That's
yeah, so
awesome.
we're always looking nationwide. So this particular RV park, we wanted to stay in our own backyard, but now that we have the experience, we'll go other states. And so, but we will only invest in landlord friendly states. So we'll
Yeah.
probably never go to California. We're not going to New York.
What
Uh,
makes it landlord friendly?
Yeah. So, what are the eviction laws? Right. So, if you do have to evict, and again, if you are an ethical, integrous landlord owner, you don't want to evict. Right. But people do, make bad decisions and they do take advantage of your kindness. Is that city, state, county easy to evict in? Right. Are they already placing rent caps? Like, we don't want anywhere that's going to inhibit any of our rights as a landlord and an owner.
Right. Right. What states what states kind of stand out to you that you definitely don't want to be in besides California and New York?
Probably not Washington, Oregon. I don't really know about Oregon, but Washington, like like the Seattle area,
Yep.
the Upper East Coast, we won't. Um, and really, that's about it as far as I know. But there are cities, right? Oh,
Hmm.
Illinois. We will never invest in Illinois. Um, but there are like certain cities that the state itself might be landlord friendly, but the city is not. And so we'll stay away from that city.
Gotcha. And you were talking about local municipalities making a pretty big impact earlier. Yeah, so that makes sense. Um, with Walk me through a successful deal that you had with multifamily. Um, where was it? Kind of what was the initial offer and what it turned into?
Yeah. So my favorite deal is the very first deal we ever did. It's 324 units in Slidell, Louisiana. And I had never done a deal before. I had never raised money before. And so this was a $30 million deal. And I think the raise was somewhere around 12 to 15 million and super significant. I had a broker that had hounded me about this deal for months and was like, this is a unicorn deal. Like, this is a deal you need to do. And I was like, there's no way. This is a $30 million deal. I've never done a deal. I don't even know how to underwrite this deal. So he actually did the underwriting for me and was like, we have to do this deal. It was advertised as a C class property. However, when we got there for due diligence, and I'm getting a little bit ahead of myself, this was not a C class property at all. This was very much a B class property. It was beautiful. It had been well cared for. The tenants have been there forever. Nobody was moving. And we were even hard pressed to be like, what capital improvements can we even do? Like, this place is just, it was so nice. But I went to my mentor at the time. 3 times I went to him and said, we've got to do this deal. This is a hot deal. We've got to do it. It's, well under rents were, gosh, I don't even remember anymore. Like, I want to say like close to $1,000 under market. And I was like, this is ridiculous. Like, the upside on this property was really $10 million. And we're actually in a sell now, and we wanted a $10 million back end, and we're up to 15 million. So that's what
Damn,
a
that's awesome.
ridiculously crazy, beautiful, amazing property this was. My mentor turned it down all 3 times. He would not do the deal with me. And in our mastermind that I was in, somebody else said, hey, I know somebody that would probably do this deal. And I said, let's go. So my husband and I drove to Dallas. We were only in San Antonio at the time, but I would drive to Dallas today from Missouri if it meant like getting a deal done. We drive all over the nation. Drove to Dallas, met this guy, seasoned in acquisitions, had money, and was like, I will totally do this deal with you. So we partnered with him, and we got the deal done, and it's amazing. We were able to raise rents $400 day one, which is unheard of and nothing that we would ever have done in a regular conventional deal. But the current management that was there had been telling the tenants, like, you pay well under market rents. Your rent is going to go up. They didn't renew anybody's leases. Everybody was month to month. And we told them in advance, like, your rent is going up $400, and nobody moved. And there was nowhere they could go because they were still like, $600
Good deal. Yeah.
under market rent, and nobody moved. And it was amazing. And I love the deal.
And then once you took over, did you keep doing month to month? Because that's pretty rare.
No, we didn't. No, we renewed everybody's leases. We just wanted them to have the opportunity to leave, without any kind of repercussions, right? Like,
Right.
you're free to go. But nobody left. No, there was nowhere to go. They were still grossly under rent. But then since then we did the ethical integrous thing, and we only raised their rent, $50 a year. And we're still under market rent, which is one of the wonderful selling points we have, is like, there's still room to raise rents, and there's nowhere they can go, and there's nowhere they will go. Cause, like, one, we're really pretty. We're in a great area. So one of the other things we look for is areas of opportunity. What can we buy that's in the path of progress? And these apartments were very much in that path of progress. About a mile down the road was nothing, fields, and swampland. And today it's like a whole shopping center. There's high-end restaurants, there's shopping, there's jobs, there's an Amazon store. So we were right beautifully in that path of progress.
Yeah. Yeah. No, for sure. That's big. That's cool. Good for you. And then also, I mean, obviously at the same time, the property's going up, with everything that's growing around it. Whenever you started talking, you mentioned B class, C class. Can you explain the difference and how that's kind of graded?
Yeah, 100%. So a C class property is a property that, again, once upon a time, it was where people wanted to live. And it's just kind of slowly fell apart, right? Like, you can drive by and see, it probably needs paint. It probably needs landscaping, might need some roofs. The cars that are parked out front are probably a little dilapidated. Where a B class is, you can really, it's really the sweet spot of the multifamily, but it's got fresh paint. The landscaping is pretty. The cars out front are working class cars, but they're not on cinder blocks, right? And the dumpsters are emptied. There's not litter. There's not dog poop everywhere. It's just, that's a B class. And then there's the A class, right? So there's the A class that are the high rises, and underneath are the restaurants and bars and amenities. And why I love B class is because when the economy is good, all the C class people, they're working, they're getting raises, they're moving into our B class properties. When the economy is bad and jobs are scarce and people aren't getting raises, and they might be losing their jobs, the A class people are moving down into our B class properties. So no matter what the economy, we stay full.
Yeah. No, that's actually, I didn't think of it that way. That's a very, very good point. It's not as cyclical as you would think.
Yeah. And so buying a C class property in a good area really gives us the opportunity to go in and clean up the problems, right? Get rid of the bad tenants, clean up the landscaping, make the apartments clean, safe, and pretty, but affordable at the same time, right? So we do want working class people to live there and be proud to live there, know they're safe living there. And and so that's really our sweet spot.
Yeah. So people invest, just a normal investor, let's say invest 50,000 into just an apartment deal. They wouldn't necessarily have controlling interest. They would just be a member in the investment. Who manages the properties and going through that process and figuring out what to do and all that?
Yeah, so that relies solely on our shoulders, on Vorsa Investments' shoulders, on my team, right? So yes, what we do is we hire a management company and we manage the management company. So we're making sure that all of our expectations are being met. We're making sure that they're following the rules that we want, that we've implemented. If there's a tenant, so in Slidell, one of our tenants was mentally disabled, but he did have a job, and the current management was worried about his rent going up, and he never paid his rent on time, but by the end of the month he was caught up, so he would pay it in increments, and the office staff would take turns paying his $25 late fee. And so, and they were really worried about him. And because he was felt like he was a burden, he would go up and down and pick up trash. And there's a little section that used to be assisted living, but it's not anymore, but the elderly kind of still live there, and he will wait for them to come home with their groceries and carry their groceries in, and he would do these things. And so they were really worried about him. And I said, when we take over, his rent, one, he never gets a late fee again. Don't pay his late fee. It doesn't exist. And his rent never goes up. What it is today is what it'll be for the duration of him living here. And I love getting to have that say, right? Yeah. I really want to take care of people that deserve to be taken care of. And so I want to make sure, again, and part of managing the management company, making sure that the hill that I'm willing to die on, they support and they know, right? And so just making sure, really watching the financials. That's not my job. That's our CFO's job. But, making sure that if we say don't spend this money, it doesn't get spent, or, so much money gets spent and allocated for this. Making sure that the tenants are vetted well. We really want good tenants. And we want to love on our tenants, right? So let's make sure we're having barbecues, and let's make sure, we're having outreach, and it feels like a family, and it feels like a community that you want to live.
Right. They definitely run into each other quite a bit. So it's definitely a community whenever you're in kind of a multifamily environment, especially if a lot of it's indoors. It's a lot easier to rub shoulders with someone just because of the entry and exit points. Um, but no, that's pretty interesting. So so you got into the deal, and you exited. Whenever you're looking for more deals, do you normally source from like online? Do you source from brokers? Do you source from, I mean, I'm sure off market properties are number one,
Mhm.
um, just to start looking at and touch before everybody else does. But what do you look for, or where do you look?
So for sure, we always are, looking for that off-market deal, right? Who do we know? And when we're talking to people, who do you know that owns an apartment building, or who in your community? Like let's be in touch. Put us in touch with them. But mostly brokers, right? So that's just part of our where our deal flow has come from, broker relations, right? And then once you transact with a broker, then you're pretty solid. And if you are really tight with your broker, right, you kind of get first dibs. Like as soon as he gets it, you can kind of have like 24 hours to underwrite the deal, pass or play before it goes out to the masses.
Yeah. Yeah, for sure. Whenever it goes out to the masses, how do you go about that? Do you go for more like an educational standpoint, like here's the information, this is kind of what it looks like?
Well, if it's a good deal and it fits our buy box, we'll underwrite it anyway, right? So even if
Yeah,
it's in the masses, like the RV park that we got, that had been on the market for a little bit, right? So all the masses had access to it, and we underwrote it, and we were like, "This is really a good deal,"
yeah,
and we executed. So it, of course, the money is always best when you can get it off market, but it doesn't make it a bad deal when it's been shot out to the masses.
yeah. What are a couple things that help you evaluate a deal better? Is there like a key statistic component that you're looking for immediately? Um, what exactly do you look for?
So this is so not my lane. Okay, so we are looking for, so we have specific buy boxes.
Can you
Um,
hear me?
I can't hear you,
Okay, cool.
but your camera is off, but I can't hear you. Um, in the underwriting, we want it to cash flow, and we want to be as close to doubling our investors' um, money as we possibly can, their distribution funds. We want to, if not double it, be real super close to doubling it. And again, we underwrite conservatively. So even though it looks like we might be just under double, if we do a good job, and we do, it probably is doubled. But we always want to under promise and over deliver.
Right.
And again, we don't know, right? So if something should happen and we didn't quite double the money, but we got where we wanted, even though all these tragic things kind of happened, we can be like, look, this, we persevered. We gave you what we initially promised. But more often than not, we're able to be like, look, we did this really good job. And even though we promised you this much money, right, we're going to give you this much money. And of course, that's where the excitement is built. And that's where referrals come from.
Yeah, yeah, absolutely. That's the fun part,
Yeah. But there
making
are
sure
key, yeah. In our calculator, there are key boxes that tell us whether it's a good deal or not. We
mhm.
know what those numbers need to be before we do a deeper dive. But I'm not the underwriter. And um, I care about what do my investors make and what do I make. Those are the only numbers that I care to know.
That's awesome. That's cool. Well, I definitely appreciate you rolling through the punches and all the questions. If someone wanted to get in touch with you, learn more about the investment opportunities, how could they do that?
The easiest way is just going to the website, super easy, vorsainvestments.com. You can book a call with me. The How to Vet a Syndication is in there. I highly recommend you get that so that whether you go with me or somebody else, these are questions that you need to be asking, right? So be informed and feel good, right? So here's the thing. If it's a 5-year hold, that's a 5-year marriage, right? Whether you're passive or not, and most of our investors are passive, but you still have the right to know, right? There are, we do monthly statements. We do, all the stuff, right? Like we are very transparent in our company. What we get, you get. So make sure, that those kind of expectations when you're vetting a syndication are met and, that your rights are being protected.
Yeah, absolutely. Did you mention your email? Sorry, I was paying attention to everything you just said.
No worries. So vorsainvestments.com. You can book a call with me through there. The ebook is there. All about us is there. How to use a self-directed retirement account. So there's tons of education in there as well.
Nice. Awesome. And I'll make sure to have that in the links as well with the book whenever we repost it. But I appreciate you coming on. Thank you for your time today.
Absolutely.
Awesome.
Thank you for having me. I really appreciate it.
Yeah, awesome. We'll chat later. Thank you.
Yes,
Thanks,
thank you.
everybody.